Oil is the lifeblood of the modern economy, but it is highly volatile. When supply tightens or demand surges, prices spike. A sudden interruption in physical crude flow can ripple outward, paralyzing supply chains and halting global economic growth in a matter of days. The prevailing geopolitical consensus treats the Organization of the Petroleum Exporting Countries and its expanded OPEC+ alliance as a traditional rent-maximizing monopoly. The assumption is simple: they artificially restrict supply to force prices higher. This chart tracks global oil market share over the last century. Before 1960, a tight oligopoly of Anglo-American firms known as the Seven Sisters controlled almost 98% of the market. Today, that dominance has shifted to the sovereign states of OPEC and OPEC+, which now control up to 59% of global production. But this market share introduces a paradox. If this alliance operates strictly to maximize profit by limiting supply, why do its members deliberately leave millions of barrels of extractable, profitable production capacity sitting offline? The answer requires looking past the traditional monopoly model. OPEC+ does not exercise absolute control. It operates closer to a global macroeconomic central bank, a stabilizing entity managing an inherently inelastic physical commodity. To analyze how this works, we have to look at OPEC as a formal intergovernmental institution. We are going to examine the econometric limits of the alliance's pricing power, the physical mechanics of maintaining global supply buffers, and the economics of the transition to renewable energy. Understanding this architecture means setting aside simple supply and demand analogies and looking directly at the structural macroeconomic mechanisms governing international trade. We are investigating whether this organization is a market anomaly or a structural requirement for systemic stability. To test the actual limits of OPEC's market influence, economists Oyenberkemi Asebi and Dumipree Joseph conducted a rigorous impact analysis of global oil pricing spanning nearly 4 decades. This ARDL bounce test determines if global demand, supply, and inflation form a long-run relationship. The result? Demand drives the market. A 1% demand increase triggers a 2.81% price jump. Conversely, a 1% OPEC supply increase only shifts prices by 0.41%. The math is definitive. OPEC lacks the statistical power to dictate the baseline price of crude oil. The demand side is too heavy. Instead, the alliance adjusts supply on the margins to trim extreme peaks and valleys caused by macroeconomic cycles. The numbers show an organization operating defensively. They react to structural shifts in global consumption, smoothing out volatility rather than overriding the market. Taking this from mathematical theory to physical reality requires looking at the infrastructure managing this volatility, the investment known as spare capacity. The EIA defines spare capacity as crude production a country can bring online within 30 days and sustain for 90. Because demand is inelastic, a sudden supply outage creates an immediate deficit. This spare capacity buffer slides in to replace missing barrels, stopping price shocks. Without that buffer, the results are catastrophic. The 1970s supply shocks led directly to physical rationing, economic paralysis, and lines at gas stations. By contrast, when Iraq invaded Kuwait in 1990, 4.5 million barrels per day vanished instantly. Because Saudi Arabia and Venezuela maintained significant offline reserves, they were able to scale up production, replacing the lost supply and stabilizing prices within months. The mechanism works in reverse as well. During the demand collapse of the 2020 COVID-19 pandemic, OPEC+ had to execute a record 9.7 million barrel per day production cut to prevent total storage saturation. Maintaining this deliberate spare capacity requires leaving billions of dollars in the ground. It acts as a privately funded insurance policy the global economy requires to survive physical disruptions. To see this central bank function tested under contemporary pressures, we can examine the 2026 blockade of the Strait of Hormuz. When geopolitical conflict shut down this critical maritime choke point, fully laden oil tankers were immobilized at sea, severing the primary artery for Middle Eastern crude. The immediate market reaction was severe. With a quarter of global seaborne exports suddenly disrupted, Brent crude prices surged above $110 per barrel. OPEC Plus intervened immediately. They announced a coordinated 206,000 barrel per day quota hike. While a fraction of the disrupted volume, It was a vital signal to traders that the alliance possessed physical supply readiness to backstop the market. Furthermore, member states bypassed the blockade. They utilized alternative overland infrastructure, specifically deploying the Adcop pipeline to reroute flow to the Red Sea, neutralizing the maritime bottleneck. During geopolitical flashpoints, it is this combination of coordinated market signaling and infrastructure diversification that prevents temporary panic buying from escalating into a deep global recession. The stabilizing effect of this alliance extends to the underlying financial engine it powers, the petrodollar. Since the 1970s, international oil trade has been conducted almost exclusively in United States dollars. This petrodollar system mandates a perpetual structural demand for U.S. currency and treasury bonds, providing deep liquidity to Western financial markets. When oil prices rise, OPEC export revenues are aggregated into trillion-dollar sovereign wealth funds like Saudi Arabia's PIF and the UAE's Mubadala. These entities reinvest that capital globally, acting as structural, counter-cyclical dampeners during broad market downturns. This financial ecosystem requires tight internal cohesion, which is now facing a structural fracture. In 2026, the UAE announced its exit from the OPEC alliance. The UAE is pivoting toward an independent strategy of petrodollar diplomacy. By stepping outside the alliance, they are decoupling their localized, lower-carbon investment strategy from the strict production constraints of the collective quota system. This rupture highlights what is at stake. The internal dynamics and strict compliance of the OPEC alliance directly dictate not just prices at the pump, but the actual liquidity and stability of the entire global dollar funding market. As the world rapidly decarbonizes, a common argument has emerged. The global shift toward renewable energy renders OPEC obsolete. This chart compares two forecasting models. The International Energy Agency projects an imminent peak in oil demand, shown by the flattening curve. However, OPEC's historically accurate reference curve projects global demand continuing to climb, reaching 123 million barrels per day by 2050. This discrepancy highlights the concept of energy realism. Treating peak demand as an immediate reality leads to severe underinvestment in legacy oil fields, long before renewable infrastructure can carry the world's baseload power, forcing a premature supply shortfall, especially for heavy sectors like steel and cement, creates prohibitive friction. Economists warn that starving the market of reliable fossil fuels too early could drive the total cost of the energy transition up by more than 70%. To prevent severe transitional energy poverty across the developing world, OPEC's data-driven investment in traditional baseload energy remains a requirement. To survive this transition while meeting global demand, OPEC has introduced an alternative framework, the circular carbon economy. This diagram maps the CCE's four strategic pillars. Instead of entirely abandoning hydrocarbons, the strategy focuses on managing emissions directly through a continuous loop: reduce, reuse, recycle, and specifically remove, relying heavily on the rapid scaling of carbon capture and storage technologies. OPEC member states are backing this framework with capital, funding industrial-scale new energy infrastructure. Initiatives like the multi-billion-dollar NEOM Green Hydrogen Project and Masdar City prove these nations are aggressive investors in future energy. The primary geopolitical reality of energy is that crude oil is a highly inelastic physical commodity. Left entirely to unchecked free markets, the system will trend towards destructive, chaotic volatility. The economic trick data and the historical record confirm that OPEC Plus is the load-bearing pillar of global macroeconomic stability.